You want somebody that's here to thrive across all different economic real estate climates. And that's why it's so important to make sure that you continue to stay the course, especially right now.
Welcome to the Cash Flow Chronicles. I'm your host, Jonny and the founder of Cattani Capital Group. For the last 2 years, I've been studying alternative assets and now help solve the problem of creating passive cash flow for creators, influencers, and busy professionals by bringing you 5 episodes a week of easy to understand education in the world of passive investing. What's up, guys? Welcome to another episode of the Cash Flow Chronicles. I'm your host, Jonny and I'm joined today by Dan Lewkowicz. Dan is a seasoned real estate veteran with over 15 years of experience in many facets of the real estate industry. Starting his career house hacking, he quickly moved up to flip houses in and around Metro Detroit and eventually created a company called Renaissance Real Estate Ventures, which specializes in the acquisition, financing, renovation, and resale of single-family residential properties in the booming city of Detroit, Michigan. Currently, Dan is Senior Director of Encore Real Estate Investment Services, specializes in shopping centers, medical office buildings, pharmacies, quick service restaurants, and automotive repair and parts stores. Dan, welcome to the show.
Hey, thank you so much for having me. I definitely appreciate it.
Absolutely. We're grateful to have you. You've got an awesome resume, and we were kind of talking offline. A lot of my listeners are new to real estate investing. So, house hacking, let's see, back when you did it, was it called house hacking?
I don't think so.
Kind of a newer term.
I don't think so. And, maybe I'm dating myself.
Sweet. Well, take us back then to kind of your first kind of introduction and how you discovered real estate investing and what's led you to where you're at now. Sure.
So the real impetus, I think, initially was all the way back in 2005. So we're talking almost 20 years ago. At the time, I had helped to start a company with some very good friends of mine called Disability Made Easy. It is a barrier-free home modification company. And for the purposes of our conversation, the part of that whole experience that really, emblazoned itself in my mind was one time I was on a trip with our project manager to a specific property, and we got there and I was just like, dude, this thing is old and it's functionally obsolete. And like, what are we going to do here? And I just watched him stand outside the property with, some graph paper and a pencil. And in 45 seconds, he had sketched out a whole new front elevation and had redone many aspects of the property. And what I realized through being part of that project was that you can take something that maybe in the 50s or 60s or 70s served its purpose perfectly, exactly as designed. And you can make significant, sometimes very small changes to the asset, and then, completely redo it and make it, serve its purpose in modern day. So, fast forward a few years, it was time for me to purchase my first home. And I'll never forget this. I was looking at one property that was like fully ready to go, exactly what we were looking for at the time. And then a few streets over, I had learned that there was some bank-owned property. This was at the, back in the last major recession. And the bank-owned property was, 35 or 40% of the price of the property that was completely finished and ready to go. So kind of, light bulb went out in my head and I said, let me buy this property. I'll renovate it. And when I'm done, I'm going to have this phantom equity that I created out of nowhere in the property. And I did that. And, when I sold the property, I sold it for significantly more than what I was, into it. And, rinse and repeat, went to another property, did exactly the same thing, bought a property from HUD, Housing and Urban Development, government organization, a foreclosure, needed a lot of work, put the work in, and boom, the property was worth significantly more. So to me, that's how I got into real estate, was that whole value add component, being able to take something, add value to it, and then having the sum be greater than the parts.
That's awesome. I love it. And, very common for kind of introduction to it, right? A lot of people start that way because of kind of the low barrier to entry, and then you kind of learn the power. And then from there, I imagine you started to scale up. Now do you still have Renaissance Real Estate? That's still.
So yeah, I still do some house flipping, but my main activity, so to speak, is commercial real estate brokerage. I look at, to me, to be frank with you, I look at house hacking and single family homes as like a gateway drug into something much bigger,
Yes, absolutely.
but I still have that itch, it's still hard for me. So, recently I was involved in, a specific property that was purchased and renovated and sold, flipped. It's definitely not my main gig. My main gig is absolutely commercial real estate brokerage. There's a lot of reasons for that. I mean, I love flipping houses, but at the same time, I don't love dealing with contractors. I don't love getting my hands dirty. I don't love when the market shifts. I don't love when prices of material go up. I don't love when my hold times increase because of unforeseen circumstances, and I don't like having all that capital tied up. Whereas in commercial brokerage, to run my business, obviously I have to spend money, but it's far less than running a house flipping business. And I'm involved in transactions where again, everything is about adding value. So I'm adding value in the transaction by being the facilitator, by being the individual that finds the deal, that underwrites it, that finds the buyer, that brings them together, and getting compensated for that. And for me, I love this business so much because one can build wealth as a commercial real estate broker without a lot of risk other than your time, right? And without a lot of investment.
That's awesome. I love it. And when I first got into the business, I was more focused on the capital side. Now switching to the active side and engaging brokers and nurturing those relationships. Obviously, transaction volume has decreased, right? We're in the business, so it's funny to get on LinkedIn and you're seeing deals still happen. It's like, oh wow, how is transaction volume decreasing? People are still doing deals, but when that's literally what your network is, it's going to appear like, there's all this buzz and this activity, but it really has slowed down. So on your end, you're in it. What are you seeing in terms of, we're almost to the end of Q1 here. What are you kind of seeing?
Yeah, good question. So, I mean, first of all, like as an organization, we have 37 brokers in 3 different offices. And in 2021, we did $935 million of transactions. In 2022, we topped that. We did $985 million of transactions. January and February of 2023 definitely were slower in our industry. That's a slow time anyway. So what I will tell you is that as an organization, we're still very, very active. I have active listings. I have properties that are going to be coming to market as active listings very soon. And, I tell people real estate is transacted every single day of the year, every single year of our existence, moving forward. That's independent of the market. There are buyers and sellers out there in any market. And there are people that are in situations where they need to buy or sell for whatever reason, independent of market conditions. Yeah. Would I like interest rates to be back at 3%? Yeah, absolutely I would, because it would increase volume, right? And it would allow people to buy the same property, let's say at a 7 cap, right? Or a 6.5 cap, and utilize that arbitrage and that spread between the interest rates and the cap rates. Whereas today interest rates are significantly higher, maybe 6.25. So yeah, I would love that. But there's no way that interest rates in the 6 or 7s or in the 20% is ever going to stop me from transacting and doing business, because we have to focus on the variables that we control. So, the answer to your question is yes, there are headwinds in our market. There are variables that are creating significant transactional reduction. Every major brokerage houses, the Marcus and Millichap, the CBREs, the JLLs are reporting a substantial and alarming decrease in sales revenue. Okay, and typically sales revenue is generated by commissions, which leads to the conclusion that transactional volume is down as well. But that's not going to stop us. We have to keep going and focus on our fundamentals. I tell people the same thing I told them during COVID. This was for me a big turning point. I listened to a lot of brokers on the phone. I had a few big listings at the beginning of COVID. A lot of brokers were telling me, hey, Dan, I'm just going to put my head in the sand, or I'm just going to sit back and do nothing for the next 6 months, wait for the market to recover and just, write this off. And I thought, man, if my competition is writing this off, then I have to double clutch this and put both, feet on the gas. And for me, that was a pivotal point in my career. I saw a tremendous increase in my volume and exposure at that point in my career. And I think that today is no different. I've been telling this to a lot of people recently. You're going to see a lot of professionals fall out of the industry. Yep. And that goes for syndicators, capital raisers, that goes for deal sponsors, that goes for investors, that goes for brokers, for loan brokers, investment sales brokers, leasing brokers, et cetera, et cetera. You're going to see a lot of people fall out. But what that means is that those people that focus on the fundamentals, that keep their nose to the ground and make sure that they're doing the activities that give them the deliverable results that they need, they're going to stick around, and they're not only going to survive, they're going to thrive, because they're going to build market share, and they're going to pick up all those clients and all those deals that would have been spread to a greater number of people.
Absolutely. I could not agree more. As someone who's newer to the industry, I was having this conversation the other day where, I believe in it so much. I'm very passionate about it. So to me, I'm actually kind of excited for obviously the reasons you said, right? People are going to fall off, but also because it's going to force those getting into it now to really learn how to do things correctly. I'm sure you can probably speak firsthand about how many new people kind of got into it over the last 2 or 3 years and just did deals. And some of them went very well, right? Because it felt like there was like, about an 18-month to 24-month period where you could just, 2x a deal just by buying it and reselling it. But those days are gone. Now you have to really implement a business plan and kind of do things correctly. You got to underwrite correctly. So it's going to make, obviously, like you said, there's some more headwinds, but, once things come back out, you're going to really see who could kind of stand the test. On that, what are you seeing in terms of like the groups that are still doing the acquisitions? Does it appear that it's kind of fallen out to the teams that have been in it for a long time and know how to weather these storms? Or are you still seeing newer groups able to kind of withstand the pressures and take on the acquisitions?
So great questions. Before I answer that, I want to backtrack a little bit to what you said. You mentioned those days are gone, right? And I'll challenge you and say that those days are definitely not gone. They're just not here right now. Real estate is
Fair.
a cyclical market, right? And I just liken it. I mean, I remember when I first started flipping houses, I was buying houses in Metro Detroit for $40,000 or $50,000. I bought a house for $10,000. This is outside of the city of Detroit. Within the city of Detroit, I mean, you could pick up houses for $2,000, $3,000, $4,000. But I remember specifically doing that in the suburbs and having to move my whole business into Detroit because the prices were going up. And I was just saying, man, and this is just from my perspective, I know it was a painful time for other people, but I said to myself, man, I wish this was, 2010 again, or 2011 or 2012 again. And then I remember as things, the value just kept shooting up, and this was in single family, but also in commercial as well. But things started shooting up. I mean, you're looking at from an investment perspective, that same house that I could have bought for $40,000 in 2010, by 2022 was probably 120 grand, right? And you're talking about 300% increase in slightly over a decade. So from an investment perspective, yeah, I want those prices to go back down to where they were in 2010. And they might not ever go that low, right? They'll go lower than they are, right? So I just think it's so important to look at the macro perspective and understand that we are in, like, if you look at interest rates, for example, yeah, we're in a higher interest rate environment than we were in 2022, 2021, 2020, 2019, 2018, 2017, et cetera, et cetera, et cetera. But we're still in a relatively low interest rate environment, yes, right? Relative to the last 30 years. And if we were to stay stable at these rates and prices of assets would stabilize, right, and fall back in line, then the real estate market would go back to its same level of efficiency it was at other times when we had price stability and kind of an equalization. And I think it's so important to keep in mind that real estate is so, especially residential, is so impacted by interest rate, right? And oftentimes we're stuck on the purchase price, we're stuck on the value of the property, but it's very easy to lose sight of the fact that the value of the property, especially in the last 5 years, in many cases, values were artificially inflated by incredibly low interest rates, and that has significantly changed, right? You're looking at, approximately 500 basis points of swing in the federal funds rate, which sets as a benchmark for other loans and rates across the spectrum. That's going to take a while to trickle down and really have its full impact in all of our, in the major commercial real estate industry and all the ancillary services as well. Now, in terms of what you had specifically asked, I deal with a lot of large institutions, real estate investment trusts, large family offices, and they're kind of, sitting there kind of like I was saying, oh man, this is great. I've got all this capital that I raised probably at lower rates, it's 18 months ago, that I now need to deploy. And I'm one of the major buyers and one of the only buyers for certain assets. So we're definitely seeing those large players, becoming more and more aggressive. I get calls probably on a weekly basis from, the representatives from these funds that are looking to place capital. You asked if there are new groups that are still buying. Yeah, there are. I have noticed a significant sector of the buyer pool that's been sitting on the sidelines about 125 basis points away from where actual pricing is, right? Like, for example, they're looking to buy 6 cap medical deals, as many as they can, at a 7.25 cap. So I've noticed that some of the smaller, newer groups are just keeping that cushion of comfort, and they're just not buying the deals that they could be buying because their risk threshold or risk tolerance is lower than others. So yeah, I'll say that there's still activity and a lot of movement. We're getting listings, we're selling product. We're just, I think that this period of uncertainty will last until we see a significant period of stability from the Federal Reserve in terms of keeping interest rates at a stable, predictable level for a significant period of time. Because right now, we still don't really know what's around the corner, which makes it very difficult to price assets right now.
Yep, absolutely. And, even a month ago, it felt like we kind of knew, right? We're like, okay, a couple more rate hikes this year, and then sounds like they'll start to taper off or even lower next year. Now that's completely changed. We'll get it. They're, in front of the banking committee today and tomorrow. So we'll know exactly what the plan is, but we could potentially see it going even higher than we anticipated even a month ago.
Strong likelihood.
Yeah. So to your point, right, still just have no idea what's going on. So do you think that's kind of one of the main factors behind the lack of seller capitulation? Like, it just feels like there's a certain variable there where sellers just aren't quite ready to move their valuations down. That might be very kind of general and short-sighted, but kind of expand on that. Let me know what you think.
I think that we've got a simple psychological principle going on. It's just straight up loss aversion, right? So what happened in this specific, nuance of the cycle that we're in is that rates went up very quickly. In fact, the fastest they've ever gone up in probably the last 20 years plus. Okay. And prices did start to fall very quickly. So, in the real estate world in general, 14 months ago is not that far in the past, right? Like, I could tell you what cap rates were 14 months ago, right? I could tell you, what type of deal was a 5 cap or a 5.25 cap. That exact same deal today is, without going into specifics of the specific asset class and nuances of the deal, that asset that was a 5 or a 5.25 cap might be a 5.75 cap, might be a 6 cap, right? Significant swings of value in a very short period of time. So I believe personally that sellers are still stuck on pricing from a lot of them that is pricing from a year and a half ago, or even just 14 months ago, because it wasn't that long ago. And it's hard to really psychologically, emotionally come to terms with the fact that value that we were screaming, hey, this value is not going to be there much longer, that value has vaporized, right, for the time being. So I think that a lot of sellers are looking at that little spread between where values were and where they are and saying that equity that's still mine, I still want prices from 14 months ago, right? And unfortunately, they can't have it. And it's very difficult to let go of that, to lose that. Even though it's already lost, I think sellers are holding on saying, oh, it's not lost. This is temporary. It's coming back. And I'm telling all my clients, barring some cataclysmic event, which God forbid, we don't want that to happen, I don't see interest rates falling back to where they were for a long time, probably not even in our lifetime. So any seller who's holding on saying, oh, well, I think in a year prices are going to be where they were in 2021, 2022. I don't think that's accurate. I think that's very risky, right? So I think that's a big part of it. In addition, you have on the other side of the table, the buyers who are saying, oh, well, I just have to open up my browser, or look on in any site and see all the doom and gloom that's out there. I think prices are headed a lot lower. So that then reinforces the problem by having an even larger disconnect where buyers are saying, oh, well, prices, yeah, today it's a 5.75 cap, but by the time I close, it's a 6 cap or a 6.25 cap. Boom, now that spread is even bigger. So that's what's causing the slowdown in the market, is what I call a dislocation in pricing between buyers and sellers. And again, I think that will even out once we have some stability and some, as you alluded to, some predictability in terms of what the Fed is going to be doing, over the next several meetings. So that I think is very important. But again, I can't stress enough. I'm just thinking of 3 or 4 examples in my head of deals I'm working on right now where, I'll give you one example. I've got a fast food restaurant in Texas where the seller is, 85 years old, and his loan is coming due in 4 months, and he just doesn't want to refi. I don't know if it's a cash flow thing. He's expressed to me he doesn't want to go through the hassle of it. That's a guy that is selling whether interest rates are at 3% or they're at 6% or they're at 16%. He's a seller now because at where he is in his life, it makes sense. There are people out there everywhere. You just have to uncover them. You just have to provide value for them and make sure that you have your eyes open. This is not a time to write anything off. This is a time to grow, to work on your fundamentals, and to make sure that you're partnering with people who aren't in this for the short term, right? You don't want a syndicator, an operator, a broker, an investor that is only like a fair weather friend. You don't want that.
Right.
You want somebody that's here to thrive across all different economic real estate climates. And that's why it's so important to make sure that you continue to stay the course, especially right now.
I love that so much. It's such a great point. I've been making that point as well. And that's kind of an issue on the capital side that we're running into, at first with investors is, now a lot of them just sitting on the sidelines, like how you kind of mentioned people are doing. But what was happening is, there were a lot of, not to say they weren't good deals, but, just quick turnarounds, 2x multiples, 2.5x multiples, 20, overinflated IRRs because it was an 18-month hold, blah, 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 right? I don't have to tell you. But what that did for investor appetite is it did not set them up well for 6% pref, 16% IRR, 5-year hold. They're like, what the heck? What is this? You're like, well, this is actually the way real estate typically trades, right?
So it's the same dislocation, right? Just in a different
same
sector.
Dislocation, exactly.
And that is a difficult barrier to cross, because today, like any investor, should be shaking in their boots. I like to try to keep it not emotional, especially when it comes to investing, but they should be shaking in their boots about inflation, right? About the fact that, today that 6% yield, okay, we're keeping up with inflation, right? You need the numbers of yesterday to get ahead today. And I think it's important, again, to just to keep your eyes open and vet those deals, vet those sponsors, vet those brokers. There are deals out there. There's always going to be deals out there. And if the general market, I'll give you an example. I know net lease, right? I'm not a syndicator. I understand it, but that's not what I do. So, in general, net lease pharmacies right now are trading, 5 cap, 6 cap, depending on the asset. I've got one listed for a 9 cap because it has some nuances in it that make it a little bit riskier or maybe a little bit more hands-on if CDS leaves. My point is that even in a market where, the deals have changed and there's not, maybe you need to do more, there's still great deals out there, and in your situation with these syndications that you're referring to, you don't have those insane home run deals like you did, or they're out there. I shouldn't say that you don't have them. They're out there. They're not as common, right? But I think what's important for people to understand is that you can make a fortune hitting singles, doubles, and triples and an occasional home run. And I do it in brokerage, right? I don't. Last year, I sold a $47.5 million set of resorts, right? That was a home run. That was probably a grand slam, right? Today, I've got a listing I'm bringing to market at 1.2 million, right? It doesn't matter. You just have to keep hitting.
1000%. And that's what I tell people is we're not really going to know if something is a home run. Like it felt like the last couple of years, you could kind of just know, right? Based on market conditions and things like that. Whereas now if you get up to bat and you're like, all right, well, this will at least give us a single, right? 6% pref, 16% IRR, 5-year hold, right? 1.8x multiple, right? You're just kind of basic. But who knows, in 5 years, that could be a freaking 2.5x multiple. And all of a sudden, it's a 22% IRR, right? We don't know that. So like you said, it's very important to pay attention to who you're investing with, where you're investing, kind of all the criteria that goes into the vetting process. It's even more important, but don't think that just because you're getting that same cookie cutter, just because you're seeing that same cookie cutter return means that's what you're going to get. You still could get better. The market, I'm not an economist, but I don't think we're going to be 5 years at this like crazy, variable rates. So.
Yeah, it's interesting. To me, it's just fascinating. I think the human psyche is so much of like, we've got that animalistic, like the right now. And I think that when rates were at 3%, a lot of people thought they'd be at 3% forever. And even now people are like, oh my gosh, everything is going to be like this forever. No, it's not. This is one moment on a large graph, right? It's like that, people talk about looking at I know we're talking real estate and I love real estate, but if you look at, stock markets, I hate the stock market because of the volatility, right? I just,
likewise,
it just drives me nuts. But if you zoom out far enough, you can see that in general, the trends are going up, right? These massive ups and downs, right? They feel terrible, but when you look at them from a more balanced macro perspective, they're not that significant. And I think that's what's going on right now is that, yeah, this is huge, right? 3% to 6.5%, that is an insane jump. But again, zoom that graph out, right? Looking at the 10-year treasury over 4%, oh my gosh, that's, earth shattering, right? It was in below, less than 0 point something, only a couple of years ago. But if you zoom out enough, you're like, okay, this is not that bad.
It is fascinating because this industry is very long-term, right? Everything, should be on a long-term mindset, yet it feels like lately we've kind of like gotten so granular at what's happening in one specific moment, as opposed to like, you guys, this is just, in 5 years, we're going to look back and be like, ha ha ha, remember when interest rates were at 6.5%,
Yeah.
And, it's like, I think, and again, this is pure speculation, but I think somewhere around the 4.5 to 5% is where things will kind of settle. And
it might.
Yeah.
It might. I don't know. That's a possibility, right. But I think that the 6% range is more realistic. And again, all that will happen is if there's interest rate stability for a long enough period of time, asset pricing will adjust. And then you'll start doing deals based on new pricing. That's just the way that it is. Just like the same way that the cap rates fell on multifamily and on, almost every asset class because interest rates went down over the last 10 to 12 years. It's the same thing. Cap rates will adjust, pricing will go down, interest rates will stabilize. If they stabilize around 6% and then they go down to 4.5, 5%, like you said, great. That'll create an influx of activity. I personally am not counting on it.
Yep. I love that. That's awesome. And that's the correct way to do it, right? Because, again, long-term mindset, you still got to get deals done and they can still be done, like you said. So it's kind of move in here. You mentioned you're into the net leases. So kind of touch on that, explain kind of what that is and how it works in the industry.
Yeah, absolutely. So typically, like when we look at real estate investment, if you look at a spectrum, so to speak, of active investing versus passive investing, you're going to have certain things like we talked about earlier in your show. We talked about house hacking or single family house flipping. That's highly active, right? You've got to source the property. You've got to source your funds, debt or whatever it is, or cash. And now you've got to, bring in your contractors or do it yourself and manage projects and, sit at the title company and find a buyer and do all these different things, right? That's very active. Multifamily has a different level of, if you look at the actual asset, right? You've got property management, you've got all kinds of responsibilities as the landlord, whether or not you hire a company or do it yourself. You still have to do things like repair the building, repair the roof, mow the grass, shovel the snow, salt the parking lot, sweep the parking lot, stripe and seal the parking lot. You have to deal with vacancy, with filling the property up, evictions, things like that. So there's definitely a level of activity there, right? And in terms of from the investor's perspective. So net lease is as far on the other side of the spectrum as you can get. It's as passive as possible. So we'll look within net lease. There are different degrees of net lease, which we'll talk about. But for our purposes and the purposes of the example right now, we can focus on the most passive form of net lease, which is what's called the absolute triple net lease. So the CVS that I referenced before is an absolute triple net lease. What that means is that if you're the landlord, you are responsible for nothing. You receive a check every month. The number that is written in the lease in terms of the rent that you collect is net to you. That's where this term net lease comes from. So the tenant actually pays for everything. Not only do they pay for the roof, the structure, the parking lot, any type of fixing or maintenance or snow or lawn care, et cetera, but they also pay for your taxes on the property, and they pay for your insurance on the property. So again, that number is net to you. So like if you look at an average apartment complex, and this is a very, very general, in fact, overgeneralization, typically on an apartment complex, if you're bringing in, let's just use round numbers, $200,000 of rental income, right, or of income from the property, you might have about 50% of that going to expenses. So you could potentially have $100,000 of taxes, insurance, maintenance, vacancy, management, et cetera, et cetera. Okay, so really you have no idea how much money you're going to have at the end of the year. You can understand, get a general idea, but things might change, right? Cost of goods might go up, cost of services might go up, your occupancy might go down, right? You might have more money on a property manager because those fees went up. Maybe you have a large capital expenditure that year. So a lot of unknowns relative to net lease. In net lease, the amount of money that's written in the lease, that's exactly what you're going to get. There's not a penny of expenses. Okay, so that's your bread and butter, cookie cutter, absolute triple net lease. So you have other examples too. So like I'll give you, so on that vein, before we switch over, I've got that Burger King I mentioned to you in Texas that I'm going to be listing. Well, guess what happened? Somebody drove a car through the entire Burger King, okay? The whole Burger King. There was a car sitting in the Burger King. Thank God they had just closed. There were only a couple people in the store. Otherwise, it would have been, a huge disaster. But guess what? Who's responsible to fix that? Who's responsible to pay rent while it's being fixed? You got it, the tenant, right? The landlord has zero responsibilities whatsoever. By the way, my client didn't even know that had happened because why? He's getting his rental check every single month. He had no idea this store has been closed for several months because of this. It wasn't until I did some research and brought it to his attention that he found out. So that's your absolute triple net lease. Now another important factor is when you're dealing with other forms of real estate assets, you've got some form, in many cases, right, some form of tenant. That tenant could be, Mr. Jones and Mrs. Smith and Mrs. Johnson and 100 other families, like individuals, right? Or in the case of an absolute triple net lease, that might be CVS corporate. That might be a 300 unit, Taco Bell operator, right? So if something goes wrong at that site, right, they can't just close up and file for bankruptcy for that location and get out of the lease. There's a whole corporation on the hook. So you have tremendous security and tremendous stability. That's one of the reasons that net lease is so attractive. And typically, because you're dealing with major corporate tenants that require top shelf real estate, the real estate itself is incredible, right? It's on hard corners, it's at lighted intersections, it's around other major traffic drawing anchors. There's huge numbers of average daily traffic going across the intersection and in front of the property. They've got great ingress and egress. So all of these things make them very, very attractive. Now, there's other forms of net lease. You've got what's called double net. In a double net lease, the tenant is still responsible for things like the taxes, the insurance, the general maintenance of the building, right? However, they're not responsible for things like roof and structure. And sometimes that can be extended to roof, structure, and parking lot. So now typically as a broker, when we underwrite deals like that, in many cases, especially if it's not brand new, we do underwrite a replacement reserve so that a certain, whether it's 15 cents or 20 cents or something like that, certain amount of money is put aside every month so that 25 years later, 30 years later, when the roof needs to be replaced, that capital is available. That's a double net lease. That's, not the absolute triple net that we just talked about. And then you have things like multi-tenant retail, like shopping centers or office retail complexes, where you have many tenants, right? And in many cases with those leases too, the tenant pays you not only the base rent, but they also pay you what's called a CAM charge or a triple net charge. CAM is known as common area maintenance. And what that is that's a certain amount that they're paying you every month to reimburse you for things like taking care of the property, plowing the snow, cutting the grass, putting the electricity in the parking lot, managing the property. So if those leases are written well, there can be a very small amount of leakage, meaning a very small difference between the actual like full income that you get and as gross income and net income, because the tenant reimbursements are done in a way that they're pretty darn accurate. So you don't really lose any of your rental income to expenses. So those are different types of net leases. I mean, we could go much deeper and go into many different categories, but in general, these are the major types of assets that we deal with. We also deal with a lot of industrial, medical office, and other types of spaces. But in general, the overarching theme is very well located real estate, very strong tenants, bulletproof leases with limited to no landlord responsibilities.
Absolutely incredible. Appreciate the explanation. That was great. It's really such an appealing asset class, right? And obviously industrial undersupplied right now. That's triple net's obviously huge in that asset class. Another thing to say on these leases as well, they're typically longer term, typically 5+ years. I've even seen upwards. I was looking at a deal that's it's a mixed use. It's got a restaurant underneath. It's on a 12-year.
Many quick service restaurant deals are 15, 20, or 25-year leases. The CVS I was referencing, it's in its first option, but that base term of the lease was a 25-year lease. So not uncommon 15, 20, 25-year leases.
And then is it called an escalation clause? Isn't there, what's that clause called where like kind of it increases about 3% every year?
So it depends on the lease, but a lot of single tenant deals have rental escalations, as you alluded to. Now they can be structured in many different ways, 1.5% every year, 2% every year. Rarely you see 3%. I think we will see larger escalations being written into the new leases because of the increase in consumer pricing index. Sometimes you'll see 5% every 5 years or 10% every 5 years. Sometimes you'll see 7.5% every 5 years. Now, obviously, it's very important to look at those different variables when you're choosing the asset to invest in, because it's far preferable to have 1% annual escalations than 5% every 5 years because of the compounding effect. So yeah, I mean, rental escalations are great. That's something I didn't even touch on, but it's so important because it's a hedge against inflation and it's guaranteed, right? It's built into the lease. You know exactly what they're going to be paying, in 20 years based on what the lease says today. And that's one of the reasons I love net lease. Like, sometimes I laugh when I see these multifamily, offering memorandums that are written, they're underwritten based on pro formas. In that lease, there is no, for the vast majority of properties, there is no pro forma. The pro forma is the lease, not a pro forma, because it's already agreed upon. So I love that because, a lot of people, when they invest in real estate, they want to do a set it and forget it. They don't want surprises. And that's what net lease offers.
Absolutely. Yeah, it really is, like I said, a very appealing investment type. And like you said, very hands-off, right? So, it's funny because you don't think about like CVS not owning the CVS, or even, your local grocery store not owning the grocery store, but it turns out that's how it works. Some group owns that whole entire complex. And so let me ask you this: before the pandemic, were grocery store anchored as popular of an investment as an asset class as they are post-pandemic?
No, I don't think people understood the value of the grocery store until the pandemic. Because when people were cooped up in their homes and a lot of things were closed, the grocery stores were packed, right? So if you look at a shopping center, it's really important to understand traffic flow and to understand who the anchor tenants are, who do they bring to your center, and are those types of individuals going to likely patronize the other businesses in the center, right? That's going to lead to a healthy, vibrant center. And I think that through COVID, we realized that grocery anchored centers, like if you're going to the grocery store, like I know me, I am lazy when it comes to shopping and when it comes to errands. Like my life is, wake up, go to work, stay here forever, go to yoga, go home. And like if I have to go out again, Like I want to do everything all at once. So it's really important. Like if I'm looking at a center, like I want to, if I have a grocery store that's in a center, like I look at it, there's two major grocery stores near my house, same grocery store. One of them is standalone. I go there because it's close. The other one is in a big center. I love every time. It's bizarre. I'm a weird creature. Every time I go to the center, I get excited because there's a Home Depot and a Kohl's and a Target and a Kroger. And I'm like, dude, you know how many like credit tenants there are? This is amazing. I love it. But anyway, my point is like if I go out, sometimes I'll go to that place because I can hit Home Depot, I can hit Target, I can hit Kroger, do it all in one fell swoop. So, the anchors at a center are so important. And to your point, yes, absolutely. I think that as an industry, we realize the value of a grocery store in a center for the overall health and wellness and traffic, vibrancy, et cetera, of the center.
Yeah, absolutely. It is fascinating, kind of the perspective shift that came from the pandemic. Like you mentioned, right? That could have been, it was very common for that to be the only thing that was keeping that center afloat, which ultimately means that group, the ownership group afloat as well, because, it was very common urban centers, right? Grocery store. And then you have like your nail salon, and those weren't really deemed essential depending on your state, of course. But it sounds like you do a lot of stuff in Texas, which, kind of really didn't subscribe to the pandemic for the most part. So, we're seeing a shift away from some of these asset classes in terms of, offices getting absolutely crushed, right? Like we're 50% from pre-pandemic. Are you seeing a shift away from certain markets in terms of these asset classes, or, are things kind of going back to the pre-pandemic as a whole?
It was really weird because there's certain factors that we look at when we're underwriting, net lease properties, and that investors look at, like, population density and proximity to, like, a central business district or a major downtown. And I remember during the pandemic, there were a lot of weird things going on during that time, right? There were a lot of rioting, a lot of unrest. It was a weird time to be alive. And I remember the same exact people who were calling me saying, "Hey, Dan, how dense is the population? Hey, Dan, how close is it to the central business district? Hey, Dan, how close is it to downtown?" They were saying, "Hey, Dan, how far away is it from the downtown? How far away is it from the central business district?" Because they didn't want to be there. And it was unbelievable because, I think, like, you look at everything that happened, there was so much rioting and looting that went on that major retailers abandoned stores in major downtowns all across the country. So there was definitely, what I called like a suburban sprawl that was going on, kind of a movement back to the suburbs, and people were more interested in that. I mean, I don't deal much in the office space, but, office in general, I think, the suburban office got stronger, whereas the downtown office got a lot weaker. So in terms of what we do, there was definitely like a shift in people's perception of what was desirable. I think that has shifted back. But I think that, some downtowns have gotten scarred to the extent that, a lot of people don't want to invest in them. Because, again, like, if you have a triple net building and it gets burned down, yeah, you're covered. Like, it's going to be okay. But the tenant might not want to renew their lease when it comes time to renew. They might want to get out of there. So, I think that there has been an impact, not a terribly significant impact, but, definitely an impact. I mean, if I'm looking at different asset classes, like I look at quick service restaurant, and man, that asset class was on fire. I mean, it was on fire before the pandemic. The pandemic, we all thought, like, oh man, these places are shut down. It's over. Like, things are going to be terrible. Cap rates went down. Prices went up. I mean, those properties became more and more and more desirable. Some of my clients were telling me that the operators of their stores were not even opening the stores even after they could, because they were able to have less staff and make more money operating only out of the drive-through. And quick service restaurant has remained relatively resilient compared to other asset classes within triple net in terms of cap rate expansion during this expansion of interest rates. We've seen cap rate expansion in quick service restaurant on a scale of maybe 25% of what we see on certain other net lease, assets. So I think that's great. I love that sector. And, I think that quick service restaurant is a great product. They're very small format, typically around 2,200 square feet, very well located, typically on signalized intersections with a lot of visibility. Many times they sit as what we call an out parcel, right, to a large shopping center. So like in the parking lot of the shopping center. So they've got built-in traffic. And a lot of times you're dealing with operators that have 3, 4, 5, 600 or 1,000 locations or more. So very strong guarantees. Frankly, during a recession, the individuals that were maybe eating at the Paneras and the Chipotles, they maybe downgrade a little bit to the Wendy's and the Burger Kings. So, I love QSR. They're pandemic proof, they're recession resistant, and the cap rates have stayed very strong.
Wow. That's awesome. And that is fascinating because, so I guess my question here, and this is pretty basic question, but like Wendy's doesn't own every single Wendy's then. Like, I know that was a big thing about McDonald's, right? Is like they own the McDonald's, but like a lot of these other chains don't necessarily own the real estate itself.
Oh yeah, most of them don't. And McDonald's is the anomaly. Wendy's does have a significant number of corporate-owned stores, more than other chains, but still, the vast majority of quick service restaurants are owned by franchisees. So if you buy a Wendy's, essentially what you're doing is you're buying the building and the lease, and there's a franchisee who's operating that store and hopefully many others, and they've got a franchise agreement with Wendy's to run a Wendy's within that location. So the strength lies in the size and strength and fiscal fortitude of the actual operator, the actual franchisee. And again, if your Wendy's goes dark, if they try to vacate, right, they can't get out of that lease. That lease is backed by the whole corporation, which may have, as I said, many hundred locations, which is again why it's so important to have a broker underwrite the deal for you. Because if I'm looking at, the exact same Wendy's on the exact same corner, exact same market, hypothetically, but one of those Wendy's has a 4-unit operator, a very small franchisee, and one has a 400-unit operator, there's a huge value to the one with the 400-unit operator. It's a much stronger guarantee. So yeah, to your question, the vast majority of quick service restaurants are not owned by the actual corporation that has their logo on the window.
Interesting. Well, there's a new fact for the day. I love that. Love learning something new. Okay, that makes sense. I kind of figured they all operated on that a McDonald's model, but that makes a lot of sense. And that explains there's now it's a chicken place, but it was a bar. They didn't own, ironically, they owned the building, but not the land. And so the landowner decided to, after their lease was up, that he wanted to demolish the building. And it was this like whole thing. But
right. So that's called a ground lease. And that's also common in our space, where the tenant builds the building, the owner owns the land, and the tenant rents from the landowner. There's also something, so that's what's called a ground lease. Okay. There is a certain security in a ground lease because the likelihood of the tenant leaving is low since they paid to build the building. Now, the downside of a ground lease is that from a tax perspective, when you depreciate something, you can only depreciate building. You can't depreciate land.
Right.
So when you own the building and the land, you can depreciate the building, but not the land. When you own a ground lease, you own only the ground, not the building, so you can depreciate nothing. Now, there's something else. It's called a leasehold interest or a sandwich lease. Now, in this case, you own the building, the tenant rents from you. So so you own the building, tenant rents from you, and then below you is the ground holder. Now you have a ground lease to pay. So you're sandwiched in between. So all you own is the building, not the land, and the tenant is renting the building from you. So tenant rents the building from you. They give you, let's say, $300,000 a year. Then you pay the ground holder that ground lease that you have between them, let's say $80,000, you keep the difference. Now, leaseholds are kind of an oddball for a lot of reasons. One of the advantages of the leasehold, in contradistinction to the ground lease, is that it's 100% depreciable because it's 100% building and 0% land.
Wow. Just when you thought you knew of all the different ways you can make money in real estate, you learned something new. I mean, it's crazy. Like, I've had people on here who trade like water rights, and like just all these nuanced things. That's why I love this industry so much. Is there's just so many ways to be successful in it, and all these little nuances. Well, that's fascinating. I really appreciate all this insight. I know I've learned a lot, and I'm sure the listeners have as well. So we'll go ahead and wind down here and jump to the final five. First question, best advice you've gotten from a mentor?
Yeah, so the best advice that I've gotten from a mentor is just, it's simple. Most advice that's good is simple, right? To never give up. Like, no matter what, never give up. I remember so many times when I was just felt like, oh man, not again. Like, I didn't succeed exactly the way I wanted to, not again. And then I remember thinking, like, who cares? Like, it's just like we've been talking about. It's just a blip in the radar screen. It's just one little segment of the S&P, right? Or of the 10-year treasury. You got to get up and keep going. So the best advice that I've ever gotten is to never quit.
Gosh, I love that so much. It's so true. That's what makes this industry can be very rewarding, but it's very challenging, especially in the beginning. And that's what really weeds people out. And, to kind of come full circle, like you said, now there's even more headwinds, which is even going to take probably even more people out. So, really, like you said, and you even said, really all it takes is just to just keep going. Like you said in the beginning of the podcast, with all these headwinds, I'm going to see a lot of people drop out, but really it's just about just keep going, keep underwriting, keep looking, and you'll be all right. Awesome. What is it about your career that makes you feel like you're fulfilling your why?
Well, I get to, I have 5 children, and I get to support them and make sure that they have good educations and that they have the training and skills that they need to be successful. So that's definitely a big part of my why, and how my job allows me to do that. And on that note, I love, like, since my daughters were, one of them was 10 and the other one was like 7 or 8, they've been messing around with drone photos and superimposing the names of tenants on top of buildings. They love what I love, because that's the nature of children. So to be able to teach them, maybe one day they'll be real estate investors or brokers or something. Maybe not, who knows? But to have that opportunity to teach them, that definitely helps me to fulfill my why. And I don't know. It's like there's a certain excitement that I get. There's a certain adrenaline that goes through my veins when I'm involved in commercial real estate, and that frankly is a part of my why, because it's what gets me up in the morning when I'm tired, and makes me get to the office and puts my head to the grindstone to get things done. And then quite frankly, being able to help people who are there's a lot of opportunities to help clients, and for me, there's nothing better than when I have a client that has a big victory. When he thinks his building is worth X and we sell it for $5 million more. To me, that's just, I love providing that value.
Absolutely. And that's the thing is, I feel like brokers sometimes get a bad rap, and not so much in the commercial space lately, but you guys want everybody to win, right? And you don't win unless both sides win. So, it's really, you're really a huge asset, right? In the industry. And I love it. Cool. Favorite non-real estate or investment related book?
Favorite non-real estate and non-investment related book? I would say it's a book called Influence, The Psychology of Persuasion. And it's all about sales psychology and just like this human psyche, how things work, reciprocity principle, loss aversion, that type of stuff. It's got a lot of fundamentals that I think are crucial.
Awesome. I love it. I'll add it to the list.
And then Think and Grow Rich. You can't go wrong with that one.
Can never go wrong with Napoleon Hill. Like, truly has stood the test of time.
I'm telling you, like, I remember reading that and I was just like, all right, I'm just going to do the stupid stuff he's asking me to do. I'm going to write it down. I'm going to say it. I'm going to think it. I'm going to feel it. You know what? I did it and it worked. Like, it worked. That just shows you the power of the mind. Like, I believe that we are virtually limitless. Like, whatever a person sets their mind to, the intention that they set, it's going to happen. Like, that's just the way that it works. And I think as we get older, we see that, right? We see the person who's always bitter and always angry and always a victim. Guess what happens? They continue to perpetuate, they find themselves in situations that create that same outcome because they already had that outcome in their head. And then we see people who just continue to succeed. And it's like, well, yeah, that guy's always positive and he's always talking about how he can make things happen. He's always helping people. And it's like, okay, well, Yeah, he's succeeding because it was already in his head. I think it's so important, like, to set that intention, set that mindset. You have control.
Absolutely. I could not agree more. And it's funny, I was just having this conversation where even like 5, 6 years ago, I was like, anybody who preaches mindset is so annoying. Like, I can't believe it. And then all of a sudden you subscribe to it and you change your mindset and you change your habits.
Yeah.
And you start doing all these little things, like you said to the first question, just little tiny changes. And all of a sudden, like all of a sudden you can get up early because you went to bed on time, and you put your phone away when you're supposed to. And like, all of a sudden, the next thing you know, your productivity increases and you're like, gosh, dang it. It really was that. That was it.
Yeah. And I'll tell you, 100% real talk. A few months ago, I got up and I was just like, dude, what am I going to do? Like, things are changing in our industry. And I started like just really questioning a lot. And like, how's it going to be? What's this year going to look like? Am I going to be like, because, it's important for me to succeed, and it's important for me to excel. And, I looked myself in the mirror and I was just like, dude, Dan, what works. Like, you got to pick up the phone, you got to make your social media posts, you got to hustle for listings, you got to put deals together. That, like, forget everything else. Like, just put that. There's nothing that you can do about any of those factors. You're not going to change Jerome Powell's decisions. You're not going to change the way the stock market's going. You're not going to change cap rates. You can influence, like, at best, you're going to influence things by doing deals, right? So just go back. What are the fundamentals? What works? And I made a spreadsheet of the last 20 deals that I closed, looking for the source of every one of those closings. And then I said, okay, well, whatever proportion this is, I'm going to put effort into, cold calls and emails and social media and these campaigns and those campaigns. And I'm going to be honest with you. Like, I sat there and I was like, I don't know what's going to happen. I really don't. But when I really just refocused myself and put my blinders on to the rest of the bullshit in the world, things started getting right back where they were. And it's amazing. So I just want to say that, like, myself personally, I've definitely experienced those moments of, questions of what's going to happen. And I've also experienced those moments of, determination leading to results.
It's awesome. I love it. Thank you for sharing that. It's so true. Cool. If you could have any superpower, what would it be?
I always wanted to fly for some reason.
Yes.
Like, I just feel like it would be so freeing.
1,000%. I love it.
Yeah. What about you?
Absolutely my answer. No
That's yours too?
asked. Yeah. And people are like, what about teleporting? I'm like, yeah, that would be great. Don't get me wrong. But I just feel like just flying itself would be so awesome.
Yeah, exactly. I could get to the same place. It would just be more fun by flying.
Absolutely. Cool. What's the best way for people to get a hold of you and learn more?
Yeah. So first of all, I'm on LinkedIn a lot. My first name is Dan. Last name is Lewkowicz, Lewkowicz. Also, if you want to talk real estate, if you have commercial property, if you want your property evaluated, or you want to talk about selling it, you can give me a call on my cell phone. It's 248-943-2838. Again, 248-943-2838. You can also, learn more about me on our website. We've got a training course for commercial real estate investors and brokers. It's called the CRE, like Commercial Real Estate Pro Course. Our website is creprocourse.com. And yeah, please reach out if there's anything I can do to add value, or you just want to talk about real estate, or if you're just getting in the game and want to talk to somebody, I'm here to help. And I always enjoy networking with good people and talking about real estate deals.
Awesome. I appreciate that. A lot of ways to connect with you. We'll link them in the show notes, make it super easy. Dan, this was absolutely amazing. Went a whole hour. Didn't even feel like it went by so fast. I appreciate your time.
Hey, my pleasure. Thank you so much.
Absolutely. Thank you again for tuning in. Who do you know that wants more cash flow? Share this episode with them so you can grow your cash flow together. If you enjoyed the show, make sure you're subscribed on your platform of choice so you never miss a new episode. Go to CataniCapitalGroup.com to learn more.